This is Greg Kilpack, and today I'm going to teach you a principle that will help you make more money in investing. And this is actually a principle that is valid not only for the stock market, but also for other assets such as real estate. Now, before I can do that, though, I need to teach you about this chart and help you understand what you're looking at and the implications of it. This is a 10-year chart of the S&P 500 index. From the current time, 2014 back to 2004, the S&P 500 Composite Index is the average price of 500 large company stocks, big companies that you've heard of like McDonald's and Microsoft and Walmart and so forth. Okay, so what's happening is that stock prices generally climb or fall together. So this is actually a chart of what almost all stock prices are doing, including smaller stocks. So from 2004 to 2007, nearly all stock prices were climbing. Then we had a big sell-off during the bear market, and since 2009, stock prices have been climbing again. Okay, these numbers are relative, so what you need to understand is it's just percentages. So from 1600 down to the fall of 800, that's about a 50% drop right there. And from less than 800 to over 1600, that's a little bit more than double. So most large company stocks on average doubled since 2009 and lost 50% during this time period. Okay, so why would that happen? What's important about that? It turns out that this is happening because more money is flowing into the economy. So companies have a greater opportunity to capture profits as that money is available. I mean, think about it. If you have more money in your pocket, you're more likely to spend more at Walmart or eat out at McDonald's or, spend your money in general. So that's what's happening, and companies are profiting from it, and so are their stock prices. Eventually, though, stock prices will get too high and people will not do as well as they were financially. And the market inevitably has a pullback. This is a normal economic event. It happens all the time. This is inevitable. This is the business cycle, and it always happens in the United States. There is always another bear market around the corner, okay, as economic conditions correct themselves from too much money supply being in the economy, okay? This happens at least once a decade, just about, sometimes 2 or 3 times a decade. So if you can learn to spot when this is coming and sell somewhere near the top and buy back somewhere near the bottom, you're going to be doing really well, okay? So what that means is investing is a lot like climbing a broken ladder. You climb up 3 or 4 steps, you hit a broken step and you fall back a couple steps. You climb up and you fall back, you climb up and you fall back. Eventually you'll get to the top, but it's a lot faster if you can avoid the broken steps, right? Well, it's the same way in the stock market. If you can learn to sell up here and buy back down here, you're going to make a lot more money than if you had just held on. You'd only be a little bit higher, all these years later, as opposed to double or more in the last few years, okay? Very important principle. If you can learn to sell up here, buy down here, you're going to be doing great. As they say, cash is king. So when assets are at discount prices, that's when you get out your cash and start buying. Now, turns out another asset follows essentially the same pattern. Now, this is a longer chart. This goes only till about 2010-11 and only all the way back to the 80s. But basically, the housing market also topped out around 2005 or 6. And then it fell during the same period that stock prices did. Okay, and the fact that it sold so hard and went down so far had a big effect on the whole economy and hurt us. Now, keep in mind, right here is when President Obama first got into office. And what is the first thing that he did and the Congress did? They pumped trillions of dollars into the economy, and it worked. It turned the economy around slowly, but it did work. Now, the economy has been improving slowly, but stock prices have been climbing pretty fast. So, all that money that has been pumped into the economy, it's got to go somewhere. There's actually a really cool article on Wikipedia about a bubble, a market bubble in tulip flowers in Holland, I think it was, back in the 1600s. Very interesting article. Same thing, too much money gets into an economy, asset classes will get inflated. That's called a bubble. All right, I have another YouTube video about bubbles. Go watch it. So anyway, this is what I teach in my classes, how to read the economic indicators and danger signals so you can sell up here and then buy back down here. If you can do that, you can make a lot more money investing in both stocks and real estate. Well, I hope you learned something new. Go to my website and learn more on my blog. Go to markettiminguniversity.com and get my free report, 3 things every investor must know to earn greater profits, take less risk, and invest with confidence. Look for my courses. They're not out just yet, but they will be in a few months. This is Greg Kilpack. Hope you learned something new, and have a great day.